Well, before the break, we mentioned that stocks were in rally mode to start this trading session. Let's get some more perspective now from Alan Nuckman. He's Chief Market Strategist at Bullseye Option. Alan, nice to see you. And obviously, this start of the day tone is different than what we had been seeing recently. Do you buy it? Does it suggest to you that the tone has changed, or is it just a new day and watch for a wild ride?
Well, I'm going to let the market tell me. So what I'm looking for here is, can we hold these gains? We've turned into a sell the rally type market instead of buy the dip. So the sentiment has really shifted in the last couple of weeks. But we'll wait and see. Monday was a big day, but we've got to build on it. And this morning, we got right essentially to the highs of Monday. But that's how a bottom gets put in. You see that extreme slam, that test and reject, and a comeback, a violent comeback. That's positive, but again, we've got to build on it here this week.
Okay, and obviously this is a huge day for central bank speak, so we're less than an hour away from a decision here in Canada, and of course this afternoon all eyes will be on the Fed. As a market participant, what are the cues you're going to be watching for?
Okay, let's talk about where we are. The market's gotten very nervous because we're going to raise rates. We're at zero. Obviously, unless we go negative, rates have to rise. If you look at the futures markets, I trust what the markets are telling me. We're going to see 4 hikes here in the States this year, and that'll bring us to a whopping 1%. And then 4 hikes next year. That gives us 2% short-term rates. That's still extremely low because there's none in the pipeline for 2024 or 2025. We'll be at 2%, still extremely low. And actually what that does is all these corporations have all this money, all this profit on their balance sheets. That'll allow them to get some yield on that money that's sitting there. So it's actually beneficial to corporations.
Okay. You know, it's been remarkable to watch coming into today's trading session. Bit of a turnaround, obviously, for tech, just this destruction in value in technology. And yet, of course, tech allows us to do all sorts of things these days, like have you join us from what I think is an airport. Your shot looks fantastic, by the way. Well done. I guess to stay with the airplane analogy, are there areas where you're watching for the market to fly higher? Like, how would you be positioning within the equity market?
Well, definitely. First, let's get back to the S&P, the broad market in general, and then I'll talk about tech. Looking at the S&P, we've seen a sell-off, a 600-point sell-off from the highs. And if we get above that midpoint, that 300 points drop, then we've seen the markets make full V recoveries, and that targets the distance of that drop from the top on those old highs, 5,400, which is about 20% higher. Now, we've seen this over and over again every time in market history that's happened. And it's really happened more in tech. If you look at the NDX, it's had this 10% sell-off probably 5 or 6 times in the last couple of years, and each and every time it's come back. So what it does is shake the tree a little bit, but there is value there. It's about risk-reward, and I still think there's a huge amount of potential in the marketplace. Stocks are now cheaper than they were a week ago. The PE of the S&P right now is below 20, so stocks are really cheap. The PE yields are higher. Again, there's not any choice. People aren't going to be putting in their money into treasuries to get a 0.5% or 1%. There's a 5% chance they're going to raise rates this week, but there's a 95% chance in March. And we've been talking about this for weeks, months, and going on years.
Before I let you go, because this is a sweet spot for you, and you danced around it a little bit, but it's sort of come up in conversation because I think everybody, you mentioned, selling the rallies as opposed to buying the dips, but we've been trying to look for any signs of when people might want to get into the markets right now. And some of our colleagues at Bloomberg were pointing out the volatility index. Mind you, I don't usually call for the volatility index. I think it just sort of gets us into these conversations that get a little bit more confusing, but it is very clear, measured by the CBOE volatility index, that volatility is going up. Can you walk us through why some might see that as actually a bullish sign?
Yeah, the fear factor, you've got to shake things up before we can move higher. We were up 25% about the S&P and the NASDAQ last year. And we had almost 70 new all-time highs in the S&P. So there has to be some profit-taking pullback to unwind, to build strength once again. And looking at the VIX had rallied, had doubled in a week. It went from 18 to 38 or whatever, 19 to 38. But the overall range from 14 lows in June to 38, the 26.5 is the midpoint that I'm keeping an eye on. Another move below that is very positive for stocks. And we've seen this over and over again. The whack-a-mole comes out. Every time the VIX rallies, it gets beaten back down, and the markets make new highs.
Got it.